of your dollars.
Welcome back, ladies and gentlemen, to the program Dollars and Cents. This is your host, Joel Garris of Nelson Financial Planning. Have you heard the ads? They're all over. It's hard to miss them. They're on radio, they're on internet, they're all over the place. And they talk about these high interest rates or rates of return that you can achieve and that they are guaranteed that you're going to make 5% or 6% or 7% or 8%, and you're never going to lose any money if the market goes down. They're all over, so I'm sure you've heard them. Well, this segment of the program, we're going to talk about what those ads are referencing, and we're going to do a little debunking of exactly what those numbers are. And at the end of the day, the conclusion is that those ads are fake ads. The very definition of fake ads. So let's start. First of all, what is it that they're ultimately advertising? What's the product in play? The product in play is an annuity. And what an annuity is basically it's a contract. It's a document, a contract that you sign as one party, and the other party to the contract is the insurance company. Because an annuity is going to be issued out by an insurance company. So we've got two parties to the contract. You, the investor, and the insurance company. You agree to give your money to the insurance company per the terms of the annuity contract, and then they agree to various guarantees and payments of streams of income. Now, when they have that money, what do you suppose they're doing with it? Well, they're taking that and doing their own investing. Well, here's the interesting thing about how insurance companies invest. And this comes to us through the National Association of Insurance Commissioners. If you look at how insurance companies in America invest those dollars, 72% of the investment portfolio of insurance companies is in fact invested in bonds. Now, at the end of the day, that really shouldn't surprise you that much because, after all, the insurance company is going to take a very conservative approach on it. I mean, that's how insurance companies operate, right? They've got a pool of assets and they have liabilities that they're going to have to pay out from that. Their requirements under the annuity contract. And so consequently, they've got to make sure that they can make those payouts. Otherwise, how good is the contract that you signed with them in the first place? So as it is, insurance companies as a whole are going to be much more conservative on how that money gets invested. And certainly the statistics reveal that if you look at the investment allocation of the assets of an insurance company, 72% of the portfolio is invested on the bond side. Only about 2% is actually invested in the stock market. The rest of it is hedges and things and options and things like that. Okay? So you've got the asset allocation. It's 72% bonds, 2% stocks, and the rest of it is basically some structured stuff that works like futures contracts, options contracts, things like that to kind of hedge the numbers. So let's think about this for just a second. The insurance company is not entering into the annuity contract without making profit. I mean, I think we all can agree that insurance companies are some of the most profitable businesses out there. And insurance companies certainly make a pretty good profit. So that profit has somehow got to come out of the performance of the assets that the insurance company holds. And with only 2% in stocks and 72% in bonds, let's come back to the prior conversation, which is very simply, okay, how much or what's the current yield on bonds today? Well under 2%. The reality is, when you stop and think about how that money is invested and what those ads are talking about in terms of rates of return, it's completely fake. because there's no way with that kind of an investment allocation that the insurance company is getting the kinds of return numbers that are advertised in those radio and internet ads. So where does it come from? Well, it comes from a little bit of a manipulation of the numbers. By including the return of your original investment into the percentage return, that's how they get to that number. So let's give an example. Let's say you gave them $100,000 and they agreed to pay you $8,000 a year for the next 20 years. The advertisement on that would say, we're going to give you 8% return, and it's guaranteed, and it's not going to fluctuate. Okay? But here's the fine print. It's good for 20 years. Okay, now wait a minute. Some simple math. If I get $8,000 a year for the next 20 years, I got $160,000. But my original investment was $100,000. And this is where it's voodoo economics, to borrow the old expression back in the Reagan days. But it's the very definition of voodoo economics. I guess today we would say it's the very definition of fake news. If you include the amount of money that you gave somebody as part of your return, that's not an accurate reflection of what your return is. If I give you $100,000 and you give me back $8,000 a year for the next 20 years, that's not an 8% return. You gave me $160,000 over that 20-year period of time. I gave you $100. How much profit did I make? 160 minus 100. I only made $60,000. Over a 20-year period of time, that means I made about $3,000 a year. Divide that number back into the 100,000, and you get your rate of return. 2%, 3%, somewhere more in line with what's reasonable. It is always surprising when people are willing to suspend basic math, basic knowledge, to believe something that just is not possible. You've got insurance companies where 72% of their invested assets are sitting in bonds. Bonds are making less than 2%. U.S. Treasuries under 2%. But yet, many people suspend that belief and think that they're going to make a return that sounds much higher. And the reality is that it's 100% fake in terms of the calculation that's being done to come up with that rate of return. So don't believe the hype. It's voodoo economics. It's fake news. Whatever generation you're from, it's got an expression, and nothing is more appropriate to label those ads as such. Nobody's getting a 5% guaranteed return, a 6%, a 7%, a 8% guaranteed return. They're simply including the money that you gave them into those numbers, and that's the fake part of the advertisement. It's not possible, right? Investment portfolios of insurance companies are 72% sitting in bonds. Not possible. Not possible for them to generate their return and also make their profit and guarantee you the kinds of numbers. So don't willingly suspend your basic common sense on a hope that somehow something is different than what it should be. I assure you it's not, and the calculations are fake. That's our take on all those ads that you hear. When we get back, we'll continue the conversation. We'll shift some gears. We'll talk about how millennials need to kind of wake up and smell the Starbucks, if you will, when we get back here on the program. This is Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio WFLA.